Been thanked before. We truly appreciate everybody's participation. Back in person again is excellent. We're about to begin the A&A update. We realize it might be a little lively for those who are not A&A people, but we'll try and keep your wits about yourself as Amber Pinsky and I, Jeff Ford, if I haven't met you, have the pleasure of talking about the A&A update for this year. A couple of things to remember as we move through the pandemic is that a lot of things changed. I think it's kind of trite now to make the comment that the pandemic changed a lot of things. But amongst the things that changed was it really had a suppressive effect on the FASB's activities. The FASB actually slowed down in the last 2 years and really did fewer things. So we have some things to talk about, to be sure, and they always tinker with things like fair value and derivatives and hedging. They can't help but do a little bit of that. But their issuance of profound new standards has really slowed. So we're going to spend some time on things that are newly applicable or things that maybe some of us put off until the last minute, something like leases perhaps. Other things happened in the pandemic were unexpected, some of which I just discovered between yesterday and today. I discovered, unbeknownst to me, that if suits hang in a closet untouched for 2 years, the waistbands shrink. So we're going to be delighted to be back in person. Our objectives are really the same as they are for most years in talking about A&A Update. We're going to focus on private companies, not public companies. We're really going to ignore almost anything that the PCAOB says or does. We're focusing on privately held middle market companies. We're not going to talk about international standards. We're going to focus on US GAAP for those private companies, and we're going to stay away from specialized industries. Of course, we'll touch a little bit here and there, but not by a whole lot. We're going to do a little bit on some SaaSes. We usually stay away from audit standards, but with the reasonably profound change in the presentation, the look of the audit reports and so forth, Amber's going to spend a little bit of time on that. A lot of pages, a little bit of time. It makes sense once you wade through the volume of it. So with some newly applicable standards, we're going to hand it to Amber.
Thank you, Jeff. So as Jeff mentioned, there hasn't been a lot by way of new updates. So for those of you that have participated in the CPE day over the last couple years, the last 2 of which have been virtual, some of these might be familiar to you. You might have heard them before, but we felt like the ones we included in our presentation today were ones that were worth noting again. So the first accounting standards update that I would like to cover is ASU 2018-15. Which provides guidance on accounting for implementation costs for cloud computing hosting arrangements that are considered service contracts. So this ASU went into effect in 2021, but we felt like it was worth noting again just due to some confusion and some questions we get often about it. So prior to this ASU, previously released ASU 2015-05 provided guidance on accounting for fees paid in a cloud computing arrangement. So under that accounting standards update, if the arrangement contains a software license, the contract is to be treated as an internal use software under ASC 350-40, and that involves capitalizing the license and the related implementation costs. If the arrangement does not have the software license, it is to be accounted for as a service contract and treated as a period expense. This ASU did not address the process for handling the implementation costs associated with the service contract, which is what led to ASU 2018-15. So ASU 2018-15 aligns the requirements for capitalizing implementation costs incurred in a hosting arrangement that is a service contract with the requirements for capitalizing implementation costs incurred to develop or obtain internal use software. So again, ASC 350-40. So what does that mean? So the different types of costs that will be capitalized are project costs to develop, to purchase, develop, or install the software generally can be capitalized. Activities related to testing, configuration, customization, and scripting can be capitalized. But costs associated with the training and data conversion, those are going to be treated as a period expense. So examples of capitalizable costs would be fees paid to an outside a third party for the development of the software, payroll and related costs for the individuals that are directly working on developing the software, and even interest costs associated while developing the project. It's important to note that as you are developing these costs, you're monitoring the costs with each project stage, because really that's going to determine how you account for it. So costs incurred during the preliminary project stage are going to be expensed under ASC 350. Implementation costs incurred during the application development stage are generally going to be capitalized, with some exceptions. And then costs incurred during the post-implementation stage, such as like maintenance and training, those are going to be treated as period expenses as they are incurred. ASU 2018-15 requires that the implementation costs be amortized over the term of the cloud computing arrangement on a straight line basis. And so the ASU also clarifies that the term of the hosting arrangement will include the non-cancelable portion of the period covered by the service contract, as well as if there is an option to extend or cancel the contract and it is reasonably certain that the customer will exercise that, you need to consider that when determining the term. And also if the entity has the option to extend or cancel the contract, that should also be considered as well. And the last point I'll make on this ASU is that the ASU requires that the entity present the expense related to the capitalized implementation costs in the same line item as the expense related to the service piece. And similarly on the cash flow, the cash paid for the capitalized implementation costs should be treated in the same manner as the payments made for fees associated with the hosting element. ASU 2019-12, so that is entitled Simplifying the Accounting for Income Taxes. This new standard didn't really change anything, any of the basic principles for accounting for income taxes, but it did simplify ASC 740 by eliminating some of the more complex and problematic provisions. There's a lot going on here. I'm just going to touch at a high level on some of these, but the first part was that it removed 4 exceptions to the general principles related to inter-period tax allocations, foreign subsidiaries, and interim periods. It also simplified the accounting for income taxes by making a few other changes. One of the most noteworthy changes relates to franchise tax. So ASU 2019-12 requires that an entity recognize franchise tax that is partially based on income as an income-based tax and account for any incremental amount that is incurred as a non-income-based tax. So as many of you may know, in certain jurisdictions, there's different ways to calculate the franchise tax, and in some, there might be a calculation based on the greater of 2. The first would be an income-based tax, and then the second might be based on something that is unrelated to income, such as capital. Under the previous guidance, only the franchise tax that is in excess of the income tax should only be recorded to the extent that they exceed the franchise taxes that were not based on income. But now under ASU 2019-12, franchise taxes calculated based on income should now be included in income tax expense. If the franchise tax is partially based on income, the portion that is related to income should be accounted for as income tax, and the deferred tax assets and liabilities should be recognized. To the extent that there's franchise taxes not based on income and that it exceeds the taxes that are based on income, the excess is going to be recorded as a non-income tax item. ASU 2019-12 also provides entities with more flexibility in accounting for the step-up basis and goodwill. On the next slide, we have a few more provisions of this accounting standards updates. So ASU 2019-12 clarifies that a parent has the option, but they are not required to, elect to allocate some of the consolidated income tax, both the current and deferred, to legal entities that are both not subject to income taxes and disregarded by taxing authorities, so such as LLCs. This can be done on an entity-by-entity basis. So if there are multiple subsidiaries, multiple single-member limited liability investments, you may elect to allocate some of the current and deferred taxes to one, but not the other. This ASU also requires that an entity reflect the effect of enacted tax changes during the period of the enactment. And there were a few other specific minor changes to the accounting standards updates, which I'm not going to mention here. But so this standard becomes effective essentially this calendar year, 2022, for private entities. ASU 2020-06, accounting for convertible instruments and contracts in an entity's own equity. So that addresses the complexity in accounting for certain financial instruments with characteristics of both liabilities and equity. So amongst other provisions, it significantly changes the accounting for convertible instruments and the guidance on the derivative scope exception in an entity's own equity. The result is that there is the expectation that there will be fewer conversion features that require separate recognition, and also fewer freestanding instruments such as warrants that require liability treatment. In an effort to simplify and not go too deep into this, just a few things I wanted to point out. So 2020-06 reduces the number of accounting models for convertible debt instruments and convertible preferred stock. So under the previous guidance, there were 5 models. That's now been reduced to 1. And so the result is that there should be a single liability or a single equity item. The overarching thought behind this standards update is just it's going to simplify things, make it easier for the preparers and the practitioners, and make the financial information more relevant to the users. There's also increased disclosure requirements that I'm not going to dive into here. And the other piece of this ASU 2020-06 relates to derivative accounting for contracts in an entity's own equity. In the current guidance, there are a number of conditions that must be met in order to meet the scope exception, and ASU 2020-06 revises the guidance and clarifies some of that.
Off to me to talk a little bit about reference rate reform and some stock compensation issues. Before we get into that, both of them will be subject to a couple of terms that are unique to our profession. So by way of a little informal glossary, let's talk about the difference between a practical expedient and an alternative. A practical expedient is really a more cost-effective way to achieve the same or the similar outcome on a reporting or an accounting matter, where an accounting alternative is, as you might suggest, a different way to account for the transaction or the reporting matter. With regard to reference rate reform, some of us actually remember when LIBOR wasn't so extant. I remember projects back in the day working with some of the people in this room where the only time I saw the word LIBOR was serving European clients. It then became ubiquitous. So much so that there was almost a sky is falling mentality as LIBOR enters what's a very protracted, almost Brett Favre retirement style sunset period. But LIBOR will go away, and we will have reference rate reform. Most of you in this room have already navigated that path, and it's really what to do about it. What to do about it by way of a practical expedient is you can look at the rate changes. If there is a rate change and it's profound, and sometimes it's really not, you can look at the contracts in which the rates were embedded and act as if they were continuing contracts and present the effects of the rate change prospectively. That can be very helpful, very, very straightforward. There is specific guidance for derivative and hedging activity, of course, many pages, and to the extent that you have reference rate reform that impacts your derivative or hedging activities, encourage you to read the ASU a little more deeply. The next slide talks about stock-based compensation. This applies only to private companies. Remember, our focus is on private companies, but unlike reference rate reform, this only applies to private companies. There was a challenge that was perceived by the standard setters that it was difficult to come up with a fair value of a private company for any stock-based award, anything along those lines, an option, an appreciation right, whatever the case may be. The feeling was that even with the extensive use of things like the Black-Scholes model and others, that several of the inputs in those models were a little bit elusive in a company that wasn't actively traded, and that there could be some wide variations in practice. There was kind of a codification with this ASU of what really developed to the more typical practice being done anyway, but it has now been codified as acceptable via practical expedient. One can use any reasonable valuation method. And they define reasonable valuation method more than the FASB usually defines terms like reasonable. They give several instances. For example, something used to meet the requirements of treasury regulations for an estate plan. That valuation that Melissa and Bob and Brad would talk about qualifies. Similarly, valuations performed by independent parties. Again, Brad, Melissa, Bob would have talked about it over the years for different purposes, such as the 409A or the 123R valuations also count as reasonable valuation methods. It's also important to note that Black-Scholes is still okay. It's also important to note that you can do these internally. It's nice. I think everybody should pay GYF to do the valuation, but you can do them internally. If you can demonstrate what you did and why you did it, that is still okay. That's a reasonable valuation method. But they do expand a little bit the disclosures that are required to tell the reader effectively what you did, why you did it, what your assumptions were with regard to very important inputs like the term, different criteria, so forth. All the things that you actually need to do if you're doing a discounted cash flow model or anything else that would yield a reasonable valuation method. Both of the last two are effective now. With regard to government assistance, Amber teases me because this has been kind of a soapbox issue. Because I guess from applicability standpoint, I'm looking for at least one person to raise their hand if you don't know anybody that received any form of government assistance from January 1st, 2020 till now. I'm going to guess no hands will go up. This includes things like PPP, employee retention credit. It includes many assistance programs unique to particular industries like the airline industry, unique to the nonprofit human services side where there were means to make up for lost units of service that were not able to be provided during certain periods of pandemic. There's actually an abundance. I've only seen maybe 10 or 15 of them, but I did see on a government presentation that it's actually in the thousands. It's in the thousands of different means of government assistance that's happened in the last couple of years. I hope I never get past my 10 or 15. But what is one to do? Well, the FASB finally did speak a little bit, and they spoke to say, we're not going to speak to this matter. There is no gap for government assistance. There is accepted practice. GAP does say that when you have something for which FASB is not going to speak, and now they spoke to say they're not going to speak, that you follow different analogies, you follow different gap analogies, and presumably you strive to achieve one that is reasonably aligned with your situation. And most people have done that. And in certain of the ones that are very extensive, PPP, ERC, they're kind of well-worn paths. But many of you will have several of those other ones, several of the other ones that are number 14 or number 457. So what is one to do? They said, well, just do this. Try and be rational, try and be reasonable. Tell the reader what you did, obviously the amounts, where did you put it, disclose where it came from, what you used it for, and what is your methodology, and move on from there. Back to Amber.
All right, so 2020-07 is applicable to non-for-profit entities. So I know we have a few of you in the audience, so now's your time to perk up and really pay attention. So this ASU is actually, I'm just gonna start by saying it's effective for periods after June 15th, 2021. So for those of you with 6/30 year ends, if you've reviewed draft audit financial statements or issued audit financial statements, you would have already seen this go into effect. Some of you, it might be in the works, but really the purpose of ASU 2020-07 is to clarify the presentation and disclosure of contributed non-financial assets. The intention is to provide the reader of the financial statements a clear understanding of what types of non-financial assets were received, how they're being used, and how they're recognized by the nonprofit. So the actual accounting for the non-financial or in-kind contributions did not change, but the presentation in the financial statements and really the note disclosures are what is impacted by this ASU. So under ASU 2020-07, the contributed non-financial assets are required to be presented as a separate line item on the statement of activities. So what does that mean? You might see a line that shows your cash contributions, and then below that you might see in-kind or non-financial contributions. Really, though, the bigger impact, apart from the face of the financial statements, is going to be the added disclosures relative to non-financial contributions. So the first new disclosure requirement is that you need to disclose a disaggregation of the amount of contributed non-financial assets recognized in the statement of activities by category. So that category doesn't need to be super granular. If you have contributed clothing, you don't need to get more granular than that. But different types of contributed non-financial assets that you might group into categories. You might see contributed clothing, contributed food, contributed inventory or merchandise, contributed equipment, legal services, any type of professional services. So those are different types of categories that you might see that you might want to group your contributed non-financial assets into. And then for each of those different categories, there's a requirement to disclose qualitative information about whether those contributions were monetized or if they were used during the reporting period. And if they were utilized, how were they utilized? What programs were they used for? There's also needs to be a disclosure of the nonprofit's policy about monetizing non-financial contributed assets. There needs to be a description of any donor-imposed restrictions and also a description of the evaluation techniques used. That could be as simple as the donated legal services were valued based on the standard billable rate for the legal services provided. So this ASU is really, as I mentioned, intended to just provide more color and more flavor to the readers of the financial statements. It is effective, as I mentioned early on, for periods after June 15th, 2021. Early adoption is permitted, and it should be adopted on a retrospective basis. So you're going to present the 2 years of information if you're presenting comparative statements. Next, we have ASU 2017-04, which is the primary goal of this ASU was to simplify the goodwill impairment test and to provide cost savings for entities. So this was accomplished by removing the requirement to determine the fair value of individual assets and liabilities in order to calculate the implied goodwill under current GAAP. So Topic 360 has historically provided for the two-step impairment test, the first step being comparing the fair value of the reporting unit to the carrying value, including goodwill. And then if that fair value is lower than the carrying value, then the companies should calculate impairment by comparing the implied fair value of goodwill to its carrying amount. So this ASU 2017-04 essentially eliminated that second step and simplified it. So now an entity should simply recognize a goodwill impairment if the reporting entity's carrying amount exceeds its fair value.
I just looked at the clock and simultaneously received 3 texts from various political candidates. But we are going to pick up the pace from here on out. We're going to hit the highlights a little more rather than some of the detail, and we're going to make sure we finish on time. So with regard to consolidation, the high points are you can wiggle out of some of the VIE requirements under the statement formerly known as 141R. There's some different measurements for related party payments, etc. But if you do this on one, you have to adopt a policy and do it on all. With regard to business combinations and customer contracts and business combinations, please remember to look up business combinations definition in 2017-01 because not every purchase of what you think is a business is a business. Sometimes it's just a group of assets, a collection of activities. But if it is a business combination, then oftentimes you have customers, contracts with customers and others that come with it. Well, the gist of this is that you act as if the buyer had originated the contract. So if you as the buyer have a bunch of contracts with, I don't know, security services or whatever you might have, you act as if you, the buyer, originated those contracts and you move on from there. There are some guidance if there's some nebulous areas of it, of course. So derivatives and hedging, this 2022-01, because we need to work in some 2022s, of course, you'll see a couple later. This is for those, very few of you, I'm guessing, that have multiple layer hedging arrangements in single closed portfolios. I bet that's not a majority in this room, but to the extent that you do, there's a lot of lovely reading inside this ASU, and it's probably very important that you take a peek at it. Amber.
So the 2022-02 is troubled debt restructuring, and so this ASU is specific to creditors. It does not impact the accounting borrowing guidance for borrowers. Really, it just eliminates the specific troubled debt restructuring and measurement guidance, and just requires an entity to evaluate whether the modification represents a new loan or a continuation of an existing loan. 2022-03 is a fair value measurement, and it's intended to reduce diversity in practice and increase the comparability of the financial statements. Specifically, this relates to when an equity security is subject to a contractual sale restriction. The guidance just clarifies that contractual sale restriction is specific to the entity that holds the security and not the security itself, and so it should not be considered when determining the fair value. This ASU also clarifies some of the illustrative guidance and also adds new disclosure requirements, but I'm not going to mention that. And the final ASU of 2022 so far today, I checked this morning, is 2022-04, which is for supplier finance programs. And so really, this ASU is intended to address the disclosure requirements surrounding the supplier finance programs. Previously, there wasn't really any guidance as far as the disclosure requirements are concerned. So this is pretty much when an entity purchases something from a supplier, they have a trade payable. They might come in and have a bank or a third-party intermediary purchase the receivable from the supplier, and in turn the supplier gets paid faster. And this ASU 2022-04 really just addresses the requirement to disclose those arrangements. They're oftentimes referred to as reverse factoring, supplier finance, supplier chain factoring, vendor payable programs. Some of those terms might sound familiar to you. If you have one of those, there's just going to be enhanced disclosure requirements, including disclosure of the program, the payment terms, any guarantees, and then really balances outstanding, where they're recorded on the balance sheet, and a roll forward of the activity during the period.
So what we've all been putting off for about 15 years would be the adoption of leases by private companies. Public companies are already done with this. This replaces, of course, FAS 13, which came out in 1976. Some of you have been reading exposure drafts on this for over 16 years. It is now here. And I think what we really end up with is a number of things that we need to kind of internalize that are less profound than originally feared, but still very important. Some of them are merely terminology changes. Capital leases are essentially unchanged. They just now are called financing leases. When we talk about all of the things that are impacted by this original ASU in 2016, it's been several revisions, as you see here. Somebody asked me 1 or 2 weeks ago, can you just tell me which one? Can you just print for me the lease statement? I said, well, here's a whole bunch of them. And you can go ahead and read all the hundreds and hundreds of pages. And there's probably several more ASUs that bump into this pronouncement. But it can all be kind of consolidated into a perspective. And that perspective is you can make this as complicated as you want to, or you could take the practical expedience and make it a relatively simple, straightforward, streamlined process. Really, a lot is left up to you, and many of the ones that you see later really help to streamline it for private companies. There is software available to implement it. And the reason we're dwelling on this today is that this became effective for private companies for years beginning after 12/15/2021, which means for 2022. An informal polling shows that high number of companies have not completed their implementation of it, at least through early in the third quarter of 2022. So it is time to be thinking about it. There's software out there. There's freeware out there. You can talk to Jason Hardy or any of your GYF representatives and we could help you find that. There's also, if you have a lot of leases, if you have hundreds of leases and they're complicated, there's software like Visual Lease that you could subscribe to for $5,000 to $10,000 per year. It'll do the disclosures for you. It'll do the evaluations for you. So you can kind of keep focused on practical implementation rather than overly complicated approaches. Amber?
So the overall impact, the biggest change you're going to see is that it's going to add an asset and a liability to the balance sheet. All entities with leases are going to be impacted. So the right-of-use asset and the lease liability are going to be added to the balance sheet, generally for leases that are over 12 months in length. The lease liability is going to be measured based on the fair value of the future lease payments, and the right-of-use asset will be based on the liability, but it is subject to adjustment for certain items, such as initial direct costs. So we can work through some examples in a bit that kind of illustrate how you calculate the value of the right-of-use asset and the value of the lease liability. As far as the income statement impact is concerned, Topic 842 retains a dual model requiring leases to be classified as either operating or finance. Operating leases result in a straight line expense, where financing leases result in a front-loaded expense. This slide here just kind of overviews one of the many ASUs that Jeff mentioned. There was some initial confusion as far as under the initial guidance, a lessor was required to exclude certain lease payments from the initial recognition of their lease receivable and would have like a loss on day one. And so this ASU kind of allows the adoption of an operating lease in those instances.
Now we're going to talk about some of the actual changes, and we're going to do it briefly as I promised before. The first section on here, the first bullet point, talks about the fact, and the second one, you need to be a little careful with your debt agreements, your debt covenants, and other commitments, because there may be some impact from this, just because we are moving these operating leases onto the balance sheet. The moving of these things onto the balance sheet, remember, was designed to eradicate off-balance sheet financing. As I've told several of you in this room, it was designed to get Delta Airlines airplanes onto their balance sheet. It was not designed to get your Pitney Bowes postage machine onto yours. So it's important to remember policies, perspective, materiality, applicability, etc. But if it was a capital lease before, it's a financing lease now, and virtually nothing has changed. Some difference with initial direct costs that wouldn't have otherwise been required, but not a particularly big deal. What about the impact on EBITDA when I move this to a right-of-use asset? Well, EBITDA is neat because it's not really a term of art. It's a casual term. It's a colloquial term. EBITDA is only operative when it's defined in a contract between one or more parties. So it's really important that your particular definition of a EBITDA, adjusted EBITDA, or whatever that may be, in your particular contracts should be looked at, and you should make sure this doesn't impact it in a detrimental way. And remember, because it is not a term of art, you may have to revisit it contract by contract, or if you have lending agreements with multiple institutions, your outcomes may differ from one to the next to the next. So important to be looking at that. Now, what about the tests for leases? So I really wish this didn't change, because I had to commit it to memory for a CPA exam years and years ago. The 4 tests, the transfer of ownership, the 75% of useful life, the 90% upfront. Well, they've kind of genericized those. We've kind of adopted the European approach of a more generic, principles-based, as opposed to a specific rules approach. And we said, well, if it basically consumes substantially all of the useful life, then it would trigger capital treatment. And they said, well, just by way of commentary, the commentator said, well, that 75% test remains a very good measure of substantially all. Similarly, the 90% test of present value of the lease payments at inception remains a pretty good test for the preponderance of the payments. But there are several things that go into that one, like the discount rate. Remember the whole implicit rate in the lease, which sometimes is hard to find? Well, more recent ASUs and updates said that private companies can use the risk-free rate. By using the risk-free rate, or your incremental collateralized borrowing rate by class, you can do a couple things. Using the practical expedients, you can save a lot of complexities. You can avoid having any income statement effect of this on a net basis. You can avoid creating new Schedule M items between you and your tax advisors. But remember my first advice. If you want to create more complexity, if you enjoy another Schedule M item, you are welcome to do that within the standard. It's really entirely up to you. Discount rate as a risk-free rate was a fabulous articulation by the FASB.
So as promised, we have 2 examples here in the material, and I will try to go over these quickly, but I do think it does help to kind of walk through the examples. So in example number 1, the company enters into the lease of a building on January 1st, 2022. The building has a fair value of $100,000 and a 10-year useful life. The lease calls for annual payments of $10,000 over a 5-year term. The lease does not transfer ownership or include a purchase option at the end of the lease. The interest rate implicit to the company is 3%. So based on the fact pattern above, the lease does not meet the criteria for a finance lease, and accordingly it will be classified as an operating lease. So a right of use asset and a lease liability will be recognized and amortized over the term of the lease. So the first step is really calculating the value of the lease liability and the right of use asset. So we first need to present value the future lease payments. So here we've illustrated to you that in present valuing the $10,000 payment over the 5-year term, it comes up with the present value of $45,797. As Jeff mentioned, we know the implicit rate is 3%. If you do not know that, you can use the incremental borrowing rate, or
we already heard a commentary that said just use a risk-free rate and keep
Yes.
on rolling.
Thank you, Jeff. Okay, so this table here we've kind of pulled together, and it really shows everything you need to know how to account for it, and a lot of what you need to disclose. So it shows the lease payments over the term of the 5 years. The columns in the middle show a breakout of the expense. Really, there's not going to be an interest charge. Both the interest and the amortization are going to be charged as lease expense, but we've kind of illustrated that there to show the difference between the present value and the lease payment. And then we show the value of the right of use asset and the lease liability at each of the reporting periods. So this is really going to be what you use to record your journal entries. So at the inception of the lease on 1/1/2022, you're going to record the right of use asset and the lease liability for $45,797. That was the present value that we calculated. At the end of the year, when you make your first lease payment, you're going to credit cash for $10,000. You're going to pay the lease payment, and you're going to record lease expense of $10,000. You're also going to adjust the right of use asset and the lease liability based on the present value calculation we did. Now let's go to another example where here the terms are the same, except you'll see the very last sentence is that to obtain the lease, the company had to pay a previous tenant $10,000. So it's still going to be classified as an operating lease, but here there's an initial director cost of $10,000. That $10,000 is going to be included in the determination of the right of use asset. So prepaid lease payments will serve to increase the initial measurement of the right of use asset, while lease incentives received will serve to decrease it. So in the first example, we had a right of use asset and a lease liability at the onset of the lease that were equal. In this case, there's going to be a $10,000 difference. So the present value of the lease payment doesn't change. The $10,000 doesn't come into that calculation. So you still calculate the lease liability using the same factors, and you come up with the $45,797. But here, the asset, we're going to add that $10,000 payment onto the value of the asset. So the asset is going to be recorded at $10,000 higher. And what's going to happen is that $10,000 is going to be amortized and charged to lease expense over the term of the lease, so 5 years on a straight line basis. So every year, $20,000 of that initial upfront payment is going to be charged to the P&L. So here you can, Jeff, can you go back one slide? So here we have the journal entries, really just pointing out, again, the numbers came directly from the previous slide from the table, but here we have at 12/31/2022, we have the lease expense is $2,000 more than it was previously, and that is because of that initial upfront payment of $10,000 that we paid.
Let's talk adoption options for those of you that haven't fully adopted and implemented. You have two. You have a comparative option and an effective date option. Comparative option's kind of neat, and it's kind of academically attractive because you show it for all periods being presented, and you go back to the beginning, the first moment in the all periods presented. It's a little more work, but the disclosures can be a little more streamlined because you're covering more data with the conversion. If you like to keep things a little bit easier, you can go with an effective date option. And I'm struggling because I can read neither the slides down there or on my notes, so I'm doing it from memory, so Amber just give me cues if I'm off a slide or two. But the effective date option is really kind of cool in the sense that you just started, in this case, January 1st, 2022, and we do it for this year. And it's really nice because I have a bunch of practical expedients we're going to talk about in a moment. The disclosures are going to be a little less streamlined, but that's kind of okay in the balance if you're looking for simplicity and clarity. Again, if you have 200 leases and they're unduly complicated, you're in a little bit different zone, different approach to this. What about the practical expedients? Well, they have this great package of 3. It sounds like a group of congresswomen that I've heard of, but it's the FASB's attempt at something like that. It's the package of 3. It's really excellent if you're looking to, if you have 10, 20, even 200 assets under lease. It can really be extremely helpful. It does a number of things. It allows you to not reevaluate whether there's a lease in a contract. It says, if it was a lease under 840, it's a lease under 842. I don't have to reopen all these contracts and think about them again. Similarly, I look at all the leases in place when I adopt, my date of adoption, the effective date. And I say, well, gee, if it was an operating lease under 840, it's an operating lease under 842. If it's a capital lease under 840, it's a capital lease under 842. And I roll forward. Then there's some other nuances there, but they're really not that bad. They're extremely helpful. An entity that has a meaningful initial direct cost, if you do this package of 3 and you do elect them together, you don't have to rethink the treatment of initial direct costs. You don't have to go back to a lease that started 4 years ago and say, I have to evaluate those initial direct costs in the way they would be evaluated under 842. However they landed for 840, they stay. You do need to apply all the 842 guidance for things going forward, of course. That should go without saying, but I did in fact say it anyway. With regard to other practical expedients, there's this hindsight expedient. The hindsight one's also kind of nice, but remember, if you use it plus the package of 3, the package of 3 take precedent, because the hindsight basically says that we might have certain things related to the lease term, and the lease term is tricky, and I'm going to cover the next 2 slides all kind of together now. And the hindsight thing says that when we have a lease term, we can just look backward and look at what happened. Did the lessee renew the lease or did they not? That determines whether it was highly likely that they would. So whenever you have reasonably certain of a lease renewal under 842, you have to use that as the term. Hindsight says, if it happened, it did. If it didn't, it didn't. And of course, to the extent that there are modifications, changes in the term, a default on the lease, change in the assets held, anything that causes you to need to modify it, you need to remeasure all of these matters. With regard to short-term leases are effectively excluded. As Amber touched on before, if it's less than 12 months, it's a short-term rental. Simple, keep it as it was, it's expense as you go. With regard to terms defined, we've kind of already sort of talked about the terms defined, and in the interest of time, I'm not going to go into significant detail about determining reasonably certain and other triggers to have to rethink that. With regard, though, to other matters that are kind of important, this first word should say remeasurement, not pre-measurement, if I'm reading it correctly. Remeasurement is necessary for changes in terms. I talked about several of those before. Be aware that they do happen. They're relatively common. Be also aware that when you have the bundle of leases, you have to disaggregate them. And in fact, if you have something big and complicated, you have to look at each of the components. This is sort of annoying to folks that have maybe 300 vehicles under lease, even though the terms are essentially the same, except they tell the leasing company when they deliver 50 more trucks or whatnot. But this says you really have to unbundle them. But remember, the software is nice, because if you lease one pickup truck this month and another one from your favorite leasing company 3 months from now, they tend to be very analogous. You can use the software to make this very easy on yourself. If you try to do that with an Excel spreadsheet, you'll probably have a lot of work in front of you. Sales leaseback guidance. Sales leasebacks really aren't as complicated as they sound. The guidance moved to much more closely conforming with revenue recognition under Section 606. There's also clarification of guidance for related party leases. Related parties, of course, result in certain additional disclosures and certain different approaches. We're capitalizing initial direct costs and other things that Amber had mentioned already. Be particularly careful of both qualitative and quantitative disclosures that are required. Be also particularly careful if you're doing something like a build-to-suit lease, if you're building out office space or a building, because they have these really arcane rules with regard to when the lessee obtains control. it can actually go onto your balance sheet when you think you're merely going through and telling the general contractor that I want to move this wall here and do that there. I want to change it from blue carpet to green carpet. The rules can be very, very complicated, but be aware that control is triggered much more sensitively than most would think throughout most of the history of the lease pronouncements. I'm going to go back to Amber now for a couple of conversations on some SASs in our final 3 minutes.
Yes. So really the next 15 pages or so in your packet are just a gift from us to you. Just a lot of the SASs that we've already covered in recent presentations. I'm not going to go through each of these because you've already heard them and we don't really have time, but we wanted to include them in the material just so you could reference them. The one I will point out is SAS 138, which amends the definition of materiality. And really, this was done to kind of conform with all of the standard setting and regulatory and judicial bodies, and kind of takes more of a legalese description to the concept of materiality. And then we also have a section here just that goes over the changes in the audit communications. Again, these already went into effect, so you should see them, but we just kept the illustrative material from last year's presentation just as a reminder of, the audit opinion the audit report looks a little different. There's, explicit disclosures of our independence, of our ethical requirements, things that aren't really new to us, but now it's explicitly covered in the report. And I think, Jeff, if you skip towards the end, we just have one potential change down the pike that we wanted to mention.
Is that the definition of SOFR, or is that a different one? So SOFR is, should be more clearly defined than this, but there is a new issuance that helps to more clearly define the SOFR rate. When we talk about change in benchmark rates, SOFR is the most common landing spot. Of course, most of you actually have that embedded in your loan agreements already or your covenants already, but stay tuned as they clarify the definitions of SOFR. We have about 1 or 2 minutes for questions before we introduce our next speaker. I know they're running with wireless mics if there's a question.
It's just quick clarification as it relates to balance sheet treatment for operating leases as this changes. Would it be similar to capital leases where it would be included in the definition of indebtedness? Is it going to be debt, or is it going to be another liability? Because I think that materially impacts indebtedness definitions and then bank covenants.
I think you have to update your definitions. I think it's going to land in different spots. It's clearly an asset. It's a right of use asset. It's clearly an obligation. And if you go back to the true accounting theory, accounting concepts when such things were actually published, an obligation to pay something over a period of time in exchange for something else was deemed to be debt-like. But under FAS 13, it was off balance sheet. The commitments were always there. Now there's essentially a present valuing of it. So I think there needs to be a meeting of the minds as to where that lands. And again, I'm going to stick by my prediction that if you're borrowing from 3 different banks, your definitions may slightly differ from bank 1 to bank 2 to bank 3, but you better be on the same page with each of those. Does that address your question?
Yeah, no. I'm going to ask Don to come back up and talk about politics, because that sounds like a political answer.
He's not going to take the banker's side, Greg.
It's not the banker's side. It's going to be the gap side as to is it debt or is it not debt? Because from a legal perspective, that definition
it is a liability.
Not indebtedness, then, is what you're saying.
I don't know. It is a liability. It is up to the contractual definition, because all the bank documents I read they actually are defining indebtedness. They're defining what's included in indebtedness and what's excluded from indebtedness. So my recommendation is, rather than wait for the standard setters to continue to clarify that, and I realize I'm shortcutting it, there is some commentary to be sure. I'm encouraging folks to make sure that they are on the same page contractually with the definitions of debt, the definition of EBITDA, the impact on the covenants, etc. Clarity, I think clarity of understanding of both parties will go a long way.